Good morning and welcome, everyone. We're going to kick off the Ohio Farmland Leasing Update webinar, and we're very happy to have you with us this morning. I know that we're going to get a few of you that continue to trickle in. It's pretty early in the morning for one of our webinars, and this is a new choice for us to go early. So we'll see how this works. We thought this might work out a little bit better in the summer. So we'll also have this recorded for later viewing. So rest assured, if you miss something, you'll have an option to watch us all over again. And as you can see by my background, I'm not really in Ohio Stadium, but I'm getting prepared for that first game against Notre Dame, at least mentally. So for those of you who are big OSU football fans, you can identify, and it's going to be here before we know it, August 11th. And it seems like the summer has continued to slip by rather quickly. Okay, let's get on with the topic at hand, and we're going to talk today about a number of leasing or leasing related issues. Again, we're glad to have you with us, and let's take a quick look at what we're going to be discussing here today. All right, here is just a quick look at the brochure or the image that we had sent out going through some of the different topics, but I'll have this in the next slide for you to have a little closer look at. So the first thing, and one of the more critical things here this summer, there was a recent law passed to change some language in the Ohio's new statutory termination law for farmland leases. We're going to talk about the new survey summary that we have out. Just yesterday, posted this to our farm office page, and I'm going to go through some of the numbers, the new Ohio cropland values and cash rents survey for 21 and 22, those results. Quick look at the economic outlook for Ohio field crops, a bit on a rental market outlook. And then we're also going to be discussing using a memorandum of lease and other practice tips that might be important to you. Our speakers today, myself, I'm leader of production business management, Peggy Kirk-Hall, attorney with the OSU Ag and Resource Law Program, who really needs no introduction, I think, to most of you. Robert Moore, also someone that's going to be very familiar with many of you, attorney with the OSU Ag and Resource Law Program as well. And then last but not least is Jeff Lewis, attorney, program coordinator, and is doing a lot of the background work with today's webinar. So we're certainly appreciative of Jeff for doing a lot of this work. Again, there's the agenda that you're going to be looking forward to today. So let's, sorry about that. We're going to find the webinar resources. The webinar slides are available for download, a PDF of those slides. And then the recording of the webinar will be available later today or later this week as we get the recording of this posted. Right. Any questions? If you have questions, we'd request that you add those to the Q&A feature, question and answer feature, and that is an option at the bottom of your Zoom screen. So you can click that, add your question, and we'll try to get to all of those today. If we don't, then you'll have to maybe follow up with us with an email, and we'll get those answered in time. The chat feature, that is for just adding comments to the dialogue, not necessarily for questions, but if you want to add a comment throughout the webinar, please feel free to do that in the chat. Okay. All right. And that brings me to the end of my comments. And you can tell that I haven't done a dress rehearsal, so I plunged right into Peggy's slides. I'm sorry about that. But at this point, I'm going to turn it over to Peggy, and we're going to get started into the meat of the webinar, unless you guys have any other thoughts or comments as far as introduction. Did I forget anything, guys?
No, I don't think so, Barry.
All right.
Thank you. Are we good on my screen?
Yeah.
All right. Okay, so good morning, everyone.
Peggy, I'm not seeing your shared slides.
You're not? It's showing that it's sharing. It's not moving.
No.
Nope, no slides.
Try this. How we go?
There again.
All right, we good?
Good to go.
Okay. Well, good morning, everybody. And thank you, Barry, for starting us off this morning. We're glad to see that some of you did show up. We were worried about what time to set this, so hopefully this time works well enough for everyone to learn about the new resources and information we have to share with you today. My job is to talk about the new law that is now effective, and you may have heard me talk about this before. We watched it go through the legislature, and it finally became effective in July 21st. So this is now the new provision. And Ohio joins all the other Midwestern states that have a similar provision in their statutory law. We were one of the last in our region to do so. And so I'm referring to it as the new law on a statutory termination date. And I call it that because it sets by statute a default termination date for farm leases if the parties haven't otherwise provided. So if you hear that language, statutory termination date, that is now what it's referring to. And you see, I know it's small on your screen there, but you see the actual law now that is codified in the Ohio Revised Code at section 5301.71. And there they're referring to it as termination of agricultural leases. So we provide links to that in the law bulletin that I will show you later, so that you can take a closer look at that statute if you so wish. But this is now effective. And just to give a little bit of background, an overview of what it does. It sets, as I said, a default provision where if a farm crop lease doesn't address a method for terminating that lease, or establish a date for the end of that lease, then this law would kick in. The Ohio Revised would kick in and address that situation by statute. And what it says then is that in that situation, if a landlord wants to terminate that lease, the landlord must do so by September 1st and must do so in writing. And so this is why we scheduled our webinar prior to September 1st to make sure. We've tried to get a lot of information out, letting landlords know September 1st is coming up. If you are in this situation where you have a lease that you want to terminate and it doesn't address termination or a method for giving notice of termination, then the clock is ticking and you have to do that by September 1st in writing. Now, the statute also provides that the termination date for that situation then will be December 31st or upon the completion of harvest of the crop that the lease is referring to, whichever is earlier. So once that crop is harvested, we would guess that would be the earlier date, although we've seen some years lately where it might not be before December 31, but that would signify the end of the lease. The lease is over at that point. So that's an overview of what the statute says. And people have been asking me, well, why did we do this? Why do we have this new law now? And I want to give then a little bit of background on where it's coming from. Now, Robert and I and many other ag attorneys across the state have answered many questions where someone will come to us and say, look, we're just in a verbal leasing situation. We've just been doing this year to year. I, pay the rent every year, and it just keeps going on and on. Well, many times in that kind of situation, it's verbal. They haven't really thought about termination, or certainly haven't addressed it in writing or even in their conversations. It's just a common farming practice, I think that we have this kind of scenario where that lease just goes on year to year. Sometimes something happens, and most often that something that happens is the landowner dies or sells the land, and new owners step in to take over ownership of that land. That's when we run into problems with the lease that is existing on that land. And the question becomes, how do we terminate this arrangement, this verbal contractual arrangement that these parties have, been implementing for the last few years or more? That's where we get into some problems. Sometimes the landlord's new owners want to terminate at a point that is a cost to that tenant. Maybe that point is in February or March, after the tenant has already made investments in the upcoming crop year. And so oftentimes we end up in a legal battle or a conflict over, well, can you terminate it that late? Isn't it too late? And what about my investments as the tenant operator? So what we try to do to avoid that is put our leases in writing and have clear provisions for how we will deal with that situation if it comes. But many times those provisions aren't there. And so now we have the new law that steps in to try to help address that situation and say, hey, if you're in that situation, you need to terminate by September 1st so that we can avoid this kind of a risk, a loss to that leasing situation. So that's why we have the new law. That's what it's intended to address, those kinds of risks that tenant operators might be in, where a lease may be terminated, perhaps what we would refer to as too late. And then we have a bit of conflict. So let me review the law itself and point out some important components of the law. First, it only applies to crop leases. So we are not referring to pasture leases, any timber leases, any building leases for either, farm structures, horticultural buildings. Neither are we referring to equipment leases. It does not apply to any of those. It only applies to farm crop leases, those leases that refer to the planting, growing, and harvesting of agricultural crops. So it's limited to that type of lease. Second, it only applies if that leasing situation has not addressed termination, a termination date or a method for terminating the lease. So when that is not provided, then this law steps in. And going a little bit further there in step 3, or in point 3, it does not void existing termination dates. If you have a lease where you have set those terms and agreed upon those terms, those remain unchanged by the new law. So it's certainly not trying to preempt what the parties have already agreed to. It's just intending to address those situations that the parties have not adequately addressed in regards to termination. Point 4 is, this is not just going to apply to a verbal lease. There's nothing in the new law that says a verbal lease. What it refers to is a lease that doesn't address termination or notice of termination. So that could be a verbal lease or a written lease. I've seen many written leases that perhaps weren't drafted by an attorney, or if they were, it wasn't a very thorough or detailed lease. And it's very possible that a written lease doesn't address termination. So that lease would be affected by this. And certainly verbal leases that are that kind of situation I described earlier, where, you've just talked out a few basic terms and haven't addressed that larger issue of termination. Both types of leases, verbal and written, can fail to address termination. And so both types would be affected by the new law. Point 5 is that it is only incumbent upon the landlord to meet the September 1st termination date. It doesn't apply to a tenant operator who wants to terminate a lease that doesn't address termination. So only the landlord is affected by this. The landlord must give notice in writing by September 1st. And then finally, point 6 is parties are free to agree otherwise. If for some reason a landlord doesn't terminate by September 1st, but wants to come in, September 2nd or 5th or October 1st and terminate, a tenant could agree to that termination. It's not a forced termination by that date that the law says. They are free to agree otherwise to how to terminate that lease. But my recommendation, of course, would be that they do that in writing to avoid any further conflicts or uncertainty. So a little bit more then on how the notice must be given. If it is to be properly given, we know that it has to be given by September 1st. And the statute says in writing. The statute also says, you see the language here, the written notice shall be delivered on or before the first day of September in the year that the termination is to be effective. And then it lists several methods of delivering that notice. By personal delivery, that could be hand delivery or mail is considered personal delivery. UPS, that type of personal delivery to the person. By fax, if there are any fax machines still out there, that would be an appropriate way to deliver the written notice. And then last, it does allow for a delivery by email, not by text, but by electronic mail. So a text would likely not suffice. There are cases that argue over whether a text is electronic mail, and those tend to reach the conclusion that no, it's not. Electronic mail is an email service. So those are the methods for giving that notice. Remember, in writing by September 1st. It says on or before September 1st. So if it's on September 1st, that's acceptable. And then using one of those delivery methods. Some recommended terms, the statute doesn't say, here's exactly what you should say to terminate. But Robert and I have talked about this, and we have some recommended terms that we would include in a notice of termination. The date of the notice, of course, being important. A clear identification of the leased property that you're referring to would also be important. And then that statement that the lease will terminate on this date or that date, unless the tenant is willing to agree to a different date. That should suffice as far as giving that notice of termination in writing. And then let's talk about a couple of scenarios and try to get a better understanding then of when this new provision would apply. So in scenario 1 here, we have a written farmland lease, and it states that the lease begins on March 1st of 2022 and ends on December 31st of 2022. It's in writing. We have a start date and end date. This is clearly a lease that has addressed a termination date. It automatically just ends on December 31st. Now, not a lot of farm leases are written that way for this short of a period. Often, and Robert, feel free to chime in here on this, but often they're written for 3 or 4 or 5 years, and so that end date might be pushed out a little further. But the point is that we have a clear termination date in this lease. So in that situation, it would not apply. The new law would not apply. Robert, I don't know. I saw you unmuted. Was there something you wanted to add to that one?
No, we were talking about this the other day that, I don't think the lease has to say, this is the termination date or, express language like that. If it has a designated term and the end of that term is clearly designated, I think that will suffice for termination.
Good. Yeah, that's a good point. And that this example doesn't say, the termination date is December 31st. That language is not necessary, but we do know by reading the language, as Robert said, that it ends. So it has addressed termination. So that's scenario 1. New law won't apply there. In scenario 2, again, another written farmland lease. But in this one, it states that it begins on January 1st, 2022 and continues from year to year unless either party terminates the lease. Now, this one is a little less clear. You have that language in there, terminates, but there is really no termination date or a method for giving notice of termination. Now, if Robert or I wrote that lease, we would have put a little more detail in there and we would have said, unless either party gives a notice of termination by September 1st or the end of the year or a month before the period, the lease renews for the next year, we would have some provisions in there, but this one does not. This one does leave it very uncertain. Okay, we know it's started, we know it's going to flip over into another year, but we really haven't addressed when it could terminate or what type of notice one party has to give the other in order to terminate it. So this is the type of lease that creates that uncertainty and risk that I referred to earlier. So in this situation, I think note that notice of termination or a termination date has not been effectively provided. And so we would need to look to that September 1st in writing termination in order to terminate that. And Robert, I hope you agree with me on this. We didn't discuss this scenario beforehand, but I intentionally wrote this one in a vague way to show that there can be a written lease that really doesn't address termination. What would you like to add to that, Robert?
No, I agree with all that. Yeah. This is the scenario where the new law would definitely apply. It's also a place where it should be addressed in the lease to start with. And
right,
so
we
it's
would
kind
hope.
of vagueness like this that I think the new law will apply and hopefully, fill in that missing part so the parties don't end up in court suing each other. They refer to the law and resolve it that way.
Right, and hopefully this illustrates to all of you the importance of not just having a written lease, but a well-written lease, and the value of just a little bit of legal oversight. An attorney, certainly an ag attorney, would catch that issue that, wait, we haven't adequately addressed termination here. When will it terminate and how much advance notice must one party give the other? Those are common provisions that I know Robert included when he was in private practice, and I did as well. So we want to avoid that uncertainty, and the new law would step in and say, okay, there is uncertainty and risk here, so we're going to say the landlord has to terminate by September 1st, or it is going to flip over into that next crop year and be effective for another year. Okay, and then scenario 3 is that verbal scenario that we know is out there, unfortunately. Far too many of our leases still in a verbal scenario. And this one is where the landlord and tenant simply, you meet every year, you agree to, okay, what's the rent going to be this year? And then it just kind of ticks along in that fashion. And maybe it's been that same landlord and operator for many years, or their predecessors. And so there haven't been any issues. It's self-sustaining lease situation. But the problem is, if, as I said before, if there's a change, we haven't addressed that issue of termination, how much notice is necessary, and whether we can effectively end that lease with that amount of notice given. So in this one, where all they've discussed basically is, hey, you want to farm this land for this much, we definitely have a void of those termination provisions. And so the new law would step in and say, in that situation, if that landlord or that landlord's successors, if something happens to that landlord, or there's a transfer of that property. In that situation, we need that written notice to be given by September 1st and effectively delivered, or it will flip over for another term, another year. And then we would look to the next September 1st if there's still a desire to terminate that lease. So hopefully that helps you see how the law will apply in the future. I have written this into a bulletin explaining these details that I've just reviewed with you, and you can find that on our farm office website in our ag law library. You can see there that we have a farm leasing shelf box in our library, and that's where this bulletin is, as well as our other farm leasing bulletins that will be helpful for putting a lease together, a checklist, those kinds of issues, how to create an enforceable lease. Those are all there on the farm leasing library on Farm Office. And with that, I will turn it back over to Barry.
Thanks, Peggy. But before you leave, I think we've got a few questions in the Q&A box. So
Okay.
it might be a good time to just go ahead and address some of those, as they're all related to this topic. And you can start to look there. I know we have one from Alan. What is the situation regarding non-cropland leases, building and equipment leases, which I think you identified or addressed that issue right out of the
Right. It does not apply to those. So, Alan, those leases, if they haven't addressed termination, are stuck in that state of uncertainty that I referred to, where someone might argue it's too late to terminate. You can't terminate. I still have it for another period. But we're less likely to see those with building and equipment type leases. I think we would see that perhaps with some of the pasture leases. There could be an issue, but in any of those situations, the law does not provide the September 1st default date for those. They're on their own according to the terms agreed to, or the course of practice between those parties. We might have to argue about when it could terminate, or when notice of termination would be given. Okay. Oh, okay. I have the questions pulled up here, Barry. I can just go through.
Good.
David Marison is asking me a question. That's unusual. David's usually on this side with me and not a participant. Hi, David. Good morning. What is a combined lease, machinery with land? Yeah, that's a good question. And I've thought about that, because the statute clarifies that, and it says leases that are solely for equipment. So that suggests that it would apply to a mixed lease if the machinery and equipment are all wrapped up into one lease, then we would apply the new provision to that one. So hopefully that answers your question, but they did think about that in advance. And many of the other, as I said, we looked to many of the other Midwestern statutes that were already in place, and have helped us with that issue of saying, ooh, there are going to be times where we have both equipment and land in one. We'll roll those in, but if it's just for equipment, it's out. Okay, what happens if you cannot harvest your crop before December 31st due to weather or other issues? And that's a good question. We've thought about that as well. What the statute says is that the lease ends on that date. So we know that you shouldn't be taking any actions for the next crop year. But it doesn't really address the issue of, but you still have rights to go in and take your crop after that end date. What actually kicks in is some common law that we have in Ohio for away-going crops. Away-going crops are crops that are still in the ground when the lease ends. And what that law says is that you two should clarify the situation as to who still owns those crops. And we've had many cases come through where the tenant couldn't get them because of weather, and the court has cited and said, yes, it's still your crop. It's an away-going crop, but you still have rights to that. But sometimes there are situations, for example, if your operator or your landlord gave you notice by September 1st and you went in and went ahead and planted wheat, that's also an away going crop that's still, that's in the ground when the lease ends. In that situation, the landlord would have the rights to the wheat. So if we're talking about harvesting the crop that was the subject of the lease, it should go with the tenant. If we're talking about the right to harvest a crop that was planted after termination was given, then we would typically see that go to the landowner. I hope that all made sense. Did that make sense, Barry? Hopefully it did. Okay. Does this law cover any termination that might have happened prior to the law passing? No. The effective date was July 21st. So any lease in existence on that effective date would be privy, would be subject to the new law, and that September 1st date would kick in. But let me read the rest of Richard's question. Example, a lease that was termination unexpected in the spring of 2022. I'm not sure. Might have happened prior to. I mean, the lease could have been in effect prior to, obviously. So any lease that's in effect right now, this new law would apply. But I'm not sure I understand, Richard, what you're asking. Do you, Barry? Do you understand the rest of his question there?
Well, I think he's talking about a lease that was terminated
Oh,
unexpectedly this spring.
I see. Oh, okay.
And
Yeah.
yeah.
Yes. So no, it wouldn't be retroactive to that termination in the spring of this year. You're okay. Thank you, Barry. I did not understand that. So Richard, your question then is, would it apply to that? No, it would not. If not, what's the best route of recovering loss? Well, unfortunately, that tenant operator is in a situation of having to argue that those losses should be reimbursed because the lease was terminated too early. And that's where, as I had mentioned before, we often end up in litigation. And it would really depend upon what happened between those parties in order for a court to say, yes, it was too late, and equity requires us to reimburse you for those lost expenses. So we could be looking at a litigation battle there. Okay, that's it, Barry.
All right. Thanks, Peggy. And if you have some more questions in this area, we'll take some time at the end to address those, because I know this is the big issue right now in farmland leasing, is trying to make sure we understand this new legislation and how it may impact both landlords and tenant farmers. Okay. All right, everyone, we're going to switch away from legal issues for a moment and talk about some economics and some results from our latest survey before we move back to legal issues towards the end with Robert. Here are just the things that I'm going to talk about over the next 20 minutes or so. We're going to take an economic outlook. We're going to take a look at an economic outlook for Ohio row crops. In other words, we're going to take a look at the first look at our budgets, our crop budgets for 2023. And we've been working on these. I've been piecing together things over the last month or more, and it's still a work in progress. We're also going to take a look at the new and just released yesterday, the Ohio cropland values and cash rents survey results for our 21-22 survey. So I'll share those with you. And then at the end, we'll take a quick look also at what our expectations are for rental markets, cash rental markets for 23. In other words, some negotiation and some thoughts for how those rents might change this fall going into 23. Okay, so the first thing, I just pulled out a few of the inputs that I think are kind of the key inputs as we're looking at crop budgets for the 23 crop year. And I know we're not done with 22 yet, but of course, many of you are planning and organizing your thoughts as far as the bottom line for 23. Just a few things, and some of these may change as we go through the next couple of months, but I'm expecting seed costs to be up about 5% roughly, and it's going to vary a little bit by our commodity crop, in particular, our corn, soybeans, and wheat, our three major crops here in Ohio. The expectation is for farm gate diesel price, at least the one that we're plugging in right now, it to be at $5 per gallon. Right now, we're a little bit above that, but the trend has been lower over the last couple of months, thankfully, along with gasoline. Fertilizer prices, we've seen some summer fill opportunities that have been a little bit lower in price than what we were experiencing back in April and May when we more or less hit our peak. But we've seen some opportunities in nitrogen, not so much in P and K. And the fundamentals of each of these are different. So our expectations, at least right now, the numbers that we're plugging in for our budgets for 23 are what you see here on your screen. And again, these are subject to a lot of factors and volatility as we head through the fall and on into the winter of 23. And the outlook for these is murky. Relying a lot on what's going on geopolitically. Some of this is largely energy based in terms of some of the factors, but a lot of the things are reliant on our crop prices. So as crop prices go, our fertilizer prices tend to follow, especially nitrogen. Okay, so right now, at least, that's what we have plugged in. Now, some of those, the nitrogen especially, are a little bit lower than what some producers experienced in the late winter and early spring for 22. However, for many, it's going to be higher than what they were cost averaging for their 22 crop, mainly because they priced and had some in storage prior to some of the big price run-ups that we experienced in the latter part of 22 or latter part of 21 into 22. So for some, this might result in higher overall fertilizer prices than what they factored in for this year's crop. So a lot of things going on with these different budget figures, and I'll address some of the others as we look at kind of the snapshot of each of these. But the first one is corn, and we're following these crop prices, and they've been softer in the last couple of months. Right now, if we're looking at the 23 December futures, we're close to that 585 per bushel. So the 565 is allowing for about a negative 20-cent basis in that deferred period in the fall of 23. You can see we're looking at effectively our trend yield, this 184, and we'll just follow this column on down. 184 bushels is the 20-year trend. So we're looking at the past 20 years and in terms of yield, corn yield in Ohio. And many of you, especially in different parts of Ohio that have better than average soils, your yield might be a little bit higher than that on your 20-year trend, but that's what we're plugging in for this analysis. And looking at our gross income, it's, we're still looking at a pretty high figure, not really looking at any ARC PLC or ad hoc government program payments to add to that for 23, and that could change. And then on down our variable costs, some of the others that we're still monitoring pretty closely, chemical costs, which took a big step up this year, not really expecting that again this next year. And probably, and my guess is, I guess this is my own personal assumption, is that we're going to see this soften a little bit. But time will tell on that. Fuel, as I mentioned, we're plugging in about $5. We're plugging in $5 a gallon on diesel. Crop insurance, as these prices soften into the winter, we may see crop insurance prices due to some other, due to the way the formula works, we may see this come down a bit. We're looking at higher rental prices, and I'll explain that here in a moment as we talk about the survey results. A pretty high number in terms of total cost per acre for an acre of corn. Returns to land, this is lower than what we saw in our 22 expectations for our 22 crop. And you can see their returns above total cost right now, and that includes all the fixed or overhead costs, if you will, looking at this point slightly negative. So you can see what our numbers look like. Lower crop prices as compared to what we were expecting in 22, and so that's going to weigh a little bit on profitability. And a lot of things, as I mentioned, we're still monitoring a lot of these costs, and this is changing weekly as we look at this analysis for 23. Soybeans, we switched to that, and 57 bushel crop yield. That price also is lower than much of what we've seen over the last few months for our 22 crop. But we look on out to November 23 futures, we adjust for a little bit of negative basis on average in Ohio, typically in the fall, and you're going to come in at about $740 gross income. All of our costs laid out down here, not all in detail. We only pull out some for just this snapshot, if you will. And you can see an acre of soybeans, as far as our analysis so far, looks to be slightly better in 23. Not much difference here as we look at the bottom lines for soybeans compared to corn. And then the next one and the last is our wheat crop into the summer of 23. And some producers are going to have to start making decisions on that pretty quickly to get wheat seed and other things as they evaluate whether or not they're going to plant some wheat this fall. We're looking at roughly 74 bushel Ohio trend yield based on that 20-year trend. And we're looking at September futures for 23 wheat, a little bit over 845. So this is adjusted for some basis. And you can see the gross income expectation, all the different costs, and wheat holds up fairly well. And we're not at those stratospheric prices of $10, $11, $12 a bushel that we experienced over parts of this spring, mainly related to the ongoing Russian invasion of Ukraine and some of those geopolitical factors, and the fact that some of that wheat was not going to be available. But we are seeing still a very strong wheat price as compared to historic averages. So this does not include any straw or double crop return. And in many parts of Ohio, and in more parts of Ohio these days, double crop soybeans following wheat are very real and meaningful additional revenue that could go along with these wheat acres. Okay, so that is a real brief outlook as far as our 23 budgets for our primary crops. And again, we're seeing a lot of things changing weekly. So this bottom line analysis is going to change as well. Okay, let's switch gears, and we're going to talk next about our survey results from our Western Ohio cropland values and cash rents study in 21-22. We collect this data in the winter from January through April, and we're surveying primarily ag lenders and appraisers throughout Ohio, and those appraisers that work on rural issues, farmland in particular, as well as some other professionals that are included in that survey effort. So this is something that we've been doing in the college since 2006, and you can access all of these past survey summaries in our farm office website. So you can access all of that past data if you're interested. Okay, so let's take a look kind of at summary information here. I know this is a rental webinar, but real quick, we're going to take a look at the valuation numbers because oftentimes they do drive future rental numbers. So we typically do see a lag in rental prices, cash rental prices, as opposed to those value changes. And we've seen some big jumps here in the last couple of years. And you can see here in 22, the expectations from those survey respondents were to see farmland values in Western Ohio jump 8 to 11.3%, depending on the region and the land class. And I'll explain that in more detail here in a moment. This is in addition to increases that we saw from 20 to 21 of anywhere between 7.2 and 26.6% in farmland values. And again, that depends on which region we're talking about, and also which land class, whether it's the bottom, the average, or the top land in those given regions. And one thing that we have seen, and this is something that's probably not news to most of you, is that prime farmland, or that top land, typically does see more dramatic increases in times of change. Okay, next on cash rents, expectations from 21 to 22, somewhere between 5.8, 6.8% change or increase in cash rental rates in this Western Ohio region. This is on top of rental increases of anywhere from 1.5 to 7.7% from 20 to 21. Now, the other question I'll address, and I know we're looking at Western Ohio only here, I'll say the Corn Belt region of Ohio, and I don't mean to offend anybody from outside of this region, but what we do see is that we just get many more responses from lenders and appraisers. The responses from other regions of Ohio that we do ask for and do collect, the numbers are very small in terms of those response rates. So it doesn't allow us to conduct any kind of statistical analysis and have any degree of reliability. So that is why those regions we aren't able to publish. Okay, so this is the region that we end up publishing year in and year out. And I know we've got some border counties here that look a lot like this so-called Western Ohio region. And many of those border counties, and even some that are 2 counties away, are going to have some farmland that has the same characteristics and the same rental markets effectively as what we're showing here. So hopefully in those counties that will this data will be meaningful as well. But this Western Ohio region, we look at average farmland, and this is what I mentioned earlier as far as the land class and the region. We're looking at the overall region, average top and bottom land. And we ask our respondents to give us their thoughts on what the average yields are in each of those land classes. And you can see for this region, about 181.8 bushel corn, 56.4 bushel soybean production on those average soils in this region. Market value change from 21 to 22, you can see around $9,700 an acre for that entire region. For rental rates, change from 214 to 228 for average land. And I also get asked the question, how do you determine how much land typically gets allotted to each of these regions? And my response is that it's not considered to be a third, and a third. Many people, many users of this survey, even though they might have average farmland, like to elevate their land into that top category. But what we typically see in the way we think about the survey results, our top land in this particular category here are usually about 10 to 15% of the land in any given region. We're talking about highly productive, flat, large parcels that would be grouped into this top category. Average land is going to be roughly 60 to 70% of the land in a given region, and then the bottom is going to take up the rest. So you can see on top land here, and I know we've seen many sales throughout this region even higher than this $12,000 an acre this year, but this is where we're at least seeing this at this point as terms of the average for top land in this region. Rental rates increasing to 283, and then the bottom land, you can see for yourself what those survey results look like. This entire summary, as well as these tables, are included in our survey summary, and that is again on our farm office site. Here's the breakdown on the specific regions, and this is the Northwest, and then I'll show the Southwest or the West Central region next. Northwest region, you can see slightly lower than the overall average in Western Ohio, but still significant change, much higher land values, especially as we look at the average in the top land, and rental rates that have increased for some in the percentages that I mentioned earlier. Okay, so that's that Northwest region, and then the other sub-region, if you will, is the Southwest or the West Central region, typically the highest land value and cash rental rates out of the two regions. And that's held up here again this year. You can see the top land averaging around, well, $13,000 plus, average land over $10,000 in this region now on arm's length transaction as we consider that number. And then the rental rates, as I mentioned, they took those steps up, those percentage increases, as I mentioned earlier. All right, here is just a breakdown of, first of all, the values that I've already identified in the previous three tables. And this is just showing those increases, the expected increases from 21 to 22. And we'll spend a little more time on this next slide as we're in a rental seminar or webinar today. So if we look at the Western average, I mentioned those corn yields and the soybean yields that our respondents are asked to identify. And then rental rates of 214 to 228, increase of 6.5%. As far as a rent per bushel of production for that 22 crop year for this year, for average land in Western Ohio, $1.25 per bushel, and a percent of land value at 2.3% in 22. So some of those numbers are meaningful to some of you on the webinar today. Okay, so that's the end of that, I guess, wrap up or that launch of this this data for this year. So again, if you have questions, contact me, or you can access again the full summary on our farm office site. Okay, and just lastly, just talking about some of the issues that I think are critical going forward into the 23 crop year and what might affect rental rates. And I guess just to state this right up front, I fully expect more upward pressure on rental rates going into 23. And it's primarily because of this second checked point here on this green side of the supportive fundamentals. And that's farmer equity positions continue to remain healthy and will probably even improve as we go through the 22 year. Ohio in general has had relatively positive weather patterns over the last few months throughout most of Ohio. Now, I know there's some areas that have had some challenges, but overall, Ohio has relatively good weather and yields look to be fairly positive, along with the crop prices that we continue to see as high, will result for most producers in relatively high gross income. Now, will they have the net income that goes along with that? Well, it depends a little bit on their cost structure. For many producers, they will still have positive net incomes in spite of the higher costs that they experienced this year, which will in turn, I believe, lead to healthier net worths. Now, how much will we expect going into 23? Well, that's open for discussion because we still will have on this other side of this balance sheet, if you will, higher input costs will continue to impact margins going into 23. And those are still volatile. So we don't know yet what that cost picture is going to look like for producers. And I think we'll continue to see, price margin outlook positive to mixed for 23, and how mixed that will be will, I think, largely drive what producers are willing to continue to put up in terms of rental increases. I would expect rental increases, however, again, to be on the table for 23. How much? I would expect it to be less than 5% due to some of the factors that we've seen here in the last month or two. Lower crop prices, continued higher input costs, I think will start to slow the rental increases into 23. Others may have different opinions, but that's my expectation at this point. Okay, now I'm going to turn it over. That's the end of my remarks, and I appreciate, again, you being with us. Again, if you have questions, reach out to me. And Robert, I'll turn it over to you. Robert, okay.
Yeah, let's try to unmute. That might help. Yeah. Can you see my slides okay?
They
Yes.
look good. Yeah.
Okay. Sorry. Okay, there we go. Okay, so today I'll talk a little bit about lease memorandums. Maybe you all are familiar with memorandums and how they're used. And then just a few kind of practical pointers as you put together leases or work with clients who have leases. So recording, typically we want to record long-term leases. And I usually consider long-term leases to be 3 years or more. You can record a 1-year lease if you want. There's no limitation on that. But what recording does is if you're the tenant and you record your lease or you record a memorandum, if the landowner, maybe an unscrupulous landowner, sells the land out from under you, basically, as tenant, if your lease is recorded, the buyer is on notice, whether they do a title search or not. The buyer is on notice that you have the land leased, and so your lease would go with the land. Typically, you don't want all of your kind of, maybe private or, business information public, which would be in the lease. So you may not want other people to see how much you're paying for rent or maybe other unique terms you have in the lease. You may want to protect those. So what you can do is record a memorandum instead. And what a memorandum does is it provides. So the memorandum will say, okay, here's the landowner, here's the tenant, here's the property being leased, and here's the length of the lease. And that's all the information it has to provide. And it has the same effect as if the lease is actually recorded. So if, again, using that scenario of you are leasing land, let's say you've got a 10-year lease on land and the landowner sells it, or maybe the landowner dies and their heirs are anxious to sell the land and they go ahead and sell the land. As long as that memorandum is recorded, whoever's buying it will either do a title search and find the memorandum and find that you are leasing the land, or the law will say they're on constructive notice. And the constructive notice basically says, hey, there's a lease or memorandum recorded. If you didn't go to the recorder's office and do a title search, that's your own fault. You're taking the property subject to the lease. Now, if you have a 10-year lease and you don't record anything, and a buyer buys the land and they truly don't know that you are leasing it and really don't have any way to know you are leasing it, then they can be what's known as an innocent buyer, and your lease could be terminated. So just record the memorandum. That's the easiest way to avoid that. So here's an example of a memorandum, and you can see how simple and basic it can be. You know, it just has the date and then the name of the tenant, name of the landowner. Then it describes how many acres are being leased. And then Exhibit A, this would be the legal description, the meets and bounds. You know, if you look at your deed, you know, all the, you know, go 1,000 feet north and 1,000 feet east, that kind of legal description, that's what Exhibit A would be, so that there's no doubt what property is subject to the memorandum. And then we put, you know, all other conditions are in a lease dated such and such. So if the buyer is looking to buy the land, they know there is a lease out there, and they can get a copy of that lease from the landowner and make sure they're aware of all the terms. And then finally, we want to make sure that the lease of the term is very obvious. And then the parties sign it, notarize it, it gets recorded, and that will protect your lease in the event that that land is transferred during the term of the lease. So on to the practical tips. Just a reminder that, you know, almost anything can be included in a lease. So as long as, you know, the two parties, the tenant and the landowner, are 18 years old and are, you know, have mental capacity to engage in a contract, you can put anything in there you want. So, you know, be creative. If your farm has very unique issues, add those in. You know, if you're the tenant and you need to do some unique things on the farm, or maybe there's some problems, you know, wet areas, or maybe some non-productive areas, be very creative yourself in setting up that lease to allow you to use the land as best as possible. So be creative. Also include as many terms as you can. Now, I'm not saying a farm lease needs to be 10 or 15 pages. That can get a little out of hand, but be as inclusive as you can. Whose responsibility is it to cut tree branches that have fallen into the field? You know, things like that. You know, fertility, which we'll talk about a little bit. Mowing, whose responsibility is it to mow the grass waterway? Try to think of as many things as you can ahead of time so that we don't have a dispute later. So tip number one, know the identity of the parties. And you may think, how could you not know the identity of the parties? The landowners own their land in trusts, and they may forget that because they may have put it in the trust 30 years ago, and it's a revocable trust, so they don't really use it. The land is titled in the trust, but you know, the trust is just sitting there kind of inactive. And so if the landowner signs the lease in their own name rather than the trust, that could be problematic. On the tenant side, is the tenant in an entity? You know, if the person signs individually and they're actually in a partnership, what does that mean for the lease? Who is actually responsible for the lease? So on both sides of the lease, just make sure you're clear who the other party is. On the landowner side, if you're the tenant, just do a quick search on the county auditor website and pull that parcel up and see how the land is titled. I think that's always a good practice, just to make sure it's not in a trust, make sure it's not owned by multiple people. You'd just be surprised how often that may happen. Number two, identify improvements. Grain bins are probably the biggest one. You know, let's say you know, you enter into a lease and you lease the whole farm, and you know, somewhere on that farm there's grain bins or buildings. Are those improvements included or not? And that should be stated very clearly, because you know, the tenant may think, well, I'm leasing the farm, the bins are included, and the landlord may think, I'm leasing the land, not the improvements. So address that in the lease ahead of time. And also, if they are included, who's responsible for kind of wear and tear, doorknobs and hinges type repairs, who's responsible for major repairs like a roof getting blown off. So go ahead and address those. But, I'm renting my 200 acres to you. If there's improvements, that is an inadequate description of what is being leased. Okay, identify what's not included. Some people think when they've leased it for farming, they've just leased it for deer season too. So I think it's always a good idea to include in the lease that you are not leasing it for recreational activities. Also, if it's been certified organic, make that very clear that only organic crops can go on it. And if there's any certain type of tillage that you do or do not want, you can put that on there as the landowner or the tenant, I suppose. So again, be creative when you draft your leases. Think about what terms are important to you, because you can include those terms and you can be very specific in those terms. Soil fertility, this is one that a lot of people know about, but maybe we don't see it in a lot of leases. And that is, a landlord could say, okay, at the beginning of the 3-year lease, we're going to take soil test, and tenant, when you leave the lease in 3 years, all the fertility numbers have to be as good or better when you leave the property, or you have to pay for that fertilizer and application. We all hear of the stories of, tenants will lease a farm for a few years, use up all the fertilizer, all the fertility, and then leave without building that back up. So be sure there's some provision in your lease that makes sure that soil fertility is maintained. Also, who pays for lime? Sometimes that can be a bit of a dispute between landowners and tenants. I think historically landowners have been usually more responsible for that. But we don't want to get in that situation of relying on custom and past patterns of business practices. Let's just put it right in the lease, who pays for lime and any other fertility issues you may have. And then enforcement and notarizing. Keep in mind, verbal leases are not enforceable. So it's a verbal lease only becomes enforceable at different times, but essentially until the check is written from the tenant to the landlord and it's cashed, or there's crop in the ground, until that lease has started to be performed upon, verbal leases are not valid. So you hear Peggy and I and everybody else say all the time, get your leases in writing. This is why, but there are still many, many verbal leases out there. Leases for 3 years or less, sorry, that should be or less, do not need notarized. Leases for more than 3 years must be notarized. If you enter into a 5-year lease and it is not notarized, you're really signing a year-to-year lease, because either party can get out at any 1 year. So if you enter into a 5-year lease and it's not notarized, after 1 year, the other party could terminate that lease. So just make sure you get long-term leases notarized, and then they should also be recorded. And again, the recording should be done by a memorandum. So those are just a few tips I had. I don't know if anybody has any questions, we can take those, but those are my comments for today.
I don't see any questions that surfaced. I'm not sure if Peggy, if you've thought any other comments that you maybe would like to make. And in the meantime, we're going to launch one polling question, which is our very short evaluation for today. So Jeff's going to launch that, and this just allows us to get a little feedback on today's webinar. Peggy, it's all yours.
Thanks, Barry. The only comment I want to make is just to remind everybody that we do have farmland leasing resources on the farm office. We have all of Barry's information. You'll find that there under his tab. There's that's the farm management box or tab. And then we also have all of our legal resources, law bulletins on the farm leasing library. And so I put that in the chat where you can get to the farm lease library. But remember, all of Barry's information is on the farm office site as well. So we try to put it all in one place for you. I do have one question that I've been hearing a lot, Barry. It's directed to you. And that has to do with the solar development that's occurring across Ohio. You know, we're currently right now in front of the power siting board. We have 90-some thousand acres converting from farmland to ag production. And then there's a lot more we know in the pipeline. And I just wondered if you could share some thoughts on that, what you think that might do, because that's a question I am getting a lot from tenant operators. Is this going to affect our rental rates in the future? Do you have any thoughts on that?
It's a question I've gotten as well. And I'll give the really classic economist's answer, and that is it depends.
Hey, wait, that's a legal answer.
Oh, is it? Okay.
We claim rights to that.
I think we all do at some point, but it certainly depends on the region, the county, those areas that are experiencing a lot more pressure and seeing a lot more development and have aggressive those tenants that are aggressive in an area and have significant commercial operations that are multi-generation operations that are, you know, planning for at least the next 2 generations. Those farms are continuing to be pretty aggressive, even in spite of those acres that are taken out of production for these solar farms. So no doubt that those areas are going to be affected. Both values, those that are competing for less acres, and also the rental markets as well. How much? That is another question entirely, as far as how much that particular piece impacts the overall change in those value and rental markets. And that is that's an entire dissertation research project, I'm sure, for each of those regions. We don't have any rules of thumb. It's impossible, because all the other factors globally are impacting what's going to happen to the price of grains, which will then impact the price of those values and rental markets. But we're getting to the point now, and a tipping point in certain counties and certain regions where no doubt it has some impact. How much? It's a really difficult proposition to dig down that deep to determine how much change that we're going to experience. Ohio, or I'll just give a county, Highland County, doesn't operate in a vacuum. So we've got, you know, all the other factors that are going to impact what's going on in that particular county, even though we're just looking at our own particular region, right? And our own county, and we're seeing all this land affected and taken out of production. But it's also an overall, you know, domestic, whole entire U.S. production, as well as global production and use, that will ultimately depend on how much impact taking those acres out of production will have. So I really weaseled around that particular question, didn't I? But it really does depend on just a myriad of factors.
Sure. Yeah, I know it's on the minds of many. So I guess we just have to wait and see how some of it plays out.
Yeah, and the thing is, how do we sort out the impacts of what's going on just in our, you know, our local markets as impacted by these solar farms that are taking some land out of production? together with all the other factors that are driving value and rental rates. So sorting that out is always going to be a difficult proposition.
Yes. Okay, and I have a question for you, Robert, as well. Because something I also hear often is, why would I need to pay an attorney to do a lease for me? Can't I just pull a form off the internet and use that? So could you just talk a little bit about, it's not that extensive to work with your attorney to get a lease, not that expensive either. What are your thoughts on that?
Yeah. Can you pull a lease off of the internet and do it yourself and probably be okay? Probably. But if you spend maybe a few $100s, an attorney might be able to help you, especially an attorney familiar with farm leases. There's going to be some unique provisions for your farm or the farm you're leasing. That general lease is going to have general terms, and there's just some unique issues, for Ohio, for regions of Ohio, and for specific farms that maybe you need in that lease. So my opinion, spending a few $100s to have an attorney review it or draft it could save you a lot of money in the end. It's not going to cost thousands of dollars to have a farm lease drafted or reviewed. A few $100. I just think it's a good investment. When you lease the farm, you're probably going to have your agronomist, or you're going to do soil tests on it to make sure it produces properly. Spend a little bit of money on the lease document to make sure the lease works for you too.
Good, I agree. All right, I don't see any other questions, Barry. So I think that wraps up our webinar.
It looks like we're close. Yes, I wanted to thank Jeff again for all of his work and effort, and we always appreciate all that. And I think that is a wrap. Just don't forget, folks. We have a recording of this, so if you want to view it again, we'll have that posted as well.